we're in a very exciting time, especially in Ontario and the rest of Canada, from the investment in startup companies. If you compare it to 9, 10 years ago, so if you look at the amount of VC capital that comes is huge. We are growing significantly, and I think in Ontario we had about $7 billion VC investment last year, which is very, very encouraging. But the devil is always in the details. So if you look at these large investment and you look at it, you see that 70-80% of it is Series B, Series C, large investments, which indicates that, again, that risk tolerance that we all, I think Joanne was referring to, is not there. And the early stage companies that are essential and the engine of these startup ecosystem it only gets a very small portion of these large VC investment. I think there is quite a few things that needs improvement. One of the things that Brad mentioned as well is I think we're oversimplifying the due diligence and also the selection that we're doing. We're trying to mimic a lot of the selections that happened. It comes from Silicon Valley, basically. We're trying to give entrepreneur 8 minutes to pitch, and then it's like everything is rehearsed when we want to invest into the companies. And then we overlooking a lot of good companies, and we're creating these trends that everybody that has a SaaS, we're going to invest, or everybody that has this recurring revenue, or just to oversimplify this. And a lot of good companies gets missed. As I mentioned before, as if somebody today comes and say, I invented LED, nobody will invest, because the first thing is hardware. It's capex intensive, and there's no SaaS in it, so we're not investing base. So you might miss such a huge change in the world because it doesn't fit that oversimplifying or categorizing the investment on early stage companies.